It's been my view for a period of time that rates have peaked. And there's two ways to answer this question, because people hear rates and they immediately think of the Fed. Well, we've heard that the Fed stopped lowering rates, and that is true. But the Fed only controls the short term, or really the overnight rate, the Fed funds rate. And the rest of the yield curve, the U.S. 10-year Treasury, 30-year Treasury, and everything in between, is simply controlled by market forces. And they do respond to what the Fed is doing, but they also respond to things that are connected to what the Fed is doing, which is inflation expectations and growth expectations. So it's true that when the Fed first started cutting late last year, or when they cut for the first time, the long end of the yield curve did go higher. That did happen. However, that's since started to reverse course. So the entire yield curve has started to come down a little bit. And I think that is a sign that things are normalizing a little bit. What was really unusual last year and the year before was the curve was inverted. Short-term rates were higher, and in some cases significantly higher than rates longer on the curve. So right now what we've got is a relatively flat yield curve, which is also unusual, but I think we're in the process of normalizing, where the short end of the curve, the Fed funds rate, is going to continue coming down. It's not going to be a smooth process. Like we've seen, the Fed is taking a break right now, and they're waiting to see just a little bit more progress on inflation, and I think we will see that. Of course, there's any number of things that could interrupt that. If tariffs do end up getting implemented, that's an inflationary force, and just who knows? There's always unknowns. If peace talks don't go well with Russia and Ukraine, that could also be inflationary because there's trade disruptions that happen there. So I think rates have peaked, and I think keep your eye on the 10-year Treasury, which, interestingly enough, the incoming Treasury Secretary Bessent has also said that they're really watching the 10-year. Because that's what mortgage rates and the bulk of borrowing costs here in the States are based on, the 10-year Treasury. So they don't want that spiking for any reason. And if the Fed is watching that, that's a pretty important clue. It is a question that we're fielding pretty regularly, just the concept of tariffs, whether they're good, whether they're bad, whether they'll actually happen, whether they will accomplish whatever the goal is. I think we're having a hard time even determining what the goal is of the tariffs. So just in the last month, we've seen certain tariff threats that have actually not ended up resulting in tariffs coming to fruition. So what it sort of feels like is this is the big threat that the U.S. is able to wield. I think, long story short, what we're doing is we're just using this as a negotiating chip. I don't know that President Trump actually wants to institute tariffs on our large trading partners, China, Canada, Mexico. I don't know that would actually benefit the United States in any way. There's really no data to support that we would have an improvement in our trade deficit as a result of tariffs. And I know that there's this other suggestion that we could replace the IRS with the ERS, the External Revenue Service, and actually replace our income tax with tariffs collected from our trade partners. Personally, I think that is far-fetched, unlikely, and just generally not good policy. But overall, just to sort of get back to the question that was asked, I think it's a mistake to plan too much for tariffs. I think we need to wait and see a little bit. For instance, there was that one weekend where there were tariff threats that were initiated on Friday after the market closed, and all weekend people were nervous that there was going to be tariffs, 25% tariffs on Canada and Mexico, which are huge trade partners of ours. We get a lot of oil from Canada. And by Monday morning, all of that had been walked back. And we had gotten some soft agreements from the leaders of Canada and Mexico about ways that they would help us with illegal immigration and drugs crossing borders and things like that. And I think that is really the message that we should be understanding, is that that's the true goal of this administration, is they want to be seen as being tough on illegal immigration, drugs crossing our borders, and not so much on trade. Are we increasing exposure to international equities? The answer is not really. Part of that is because we've already had an allocation to international equities and emerging markets, and we've been beneficiaries of the fact that those have started to inflect a little bit against US equities. And you can notice that there's almost a direct correlation with about midway through January, the US dollar peaked, short term anyway, and started to finally break a little bit lower. And since then, we have seen outperformance in emerging markets and international large cap equities versus their US counterparts. So, and I think what happened was, so this is why it's a little bit, a lot built into this question, because tariff talk is a big part of what was strengthening the US dollar. And so when there was some evidence that maybe tariffs were not going to be wielded in the same way as feared, and maybe some wouldn't even end up actually being implemented at all, that's roughly when we saw the dollar start to come off a little bit and relief in international stocks. So, but if you go back a little bit further, US stocks are still outperforming international stocks over the last 6 months or so. So this is a little bit of a new trend. It's definitely something worth watching. I don't think it makes sense to make huge shifts in allocations. But a good portfolio has something that's losing at all times. You know, if you're truly diversified, there's something you hate in your portfolio. And, you know, for a good part of the last year or two, international stocks and especially emerging markets have been the thing that you've hated. So those getting a little bit of a boost is welcome for people who have been properly diversified. It's a little funny to be answering the question, what could go right, when markets they're not quite at all-time highs, but they're darn close. But it's true, investors are super nervous. And the question is, should they be? I know that headlines are scary. They're certainly volatile. There are a lot of, there seems to be a lot of headline risk. I think, however, there are a lot of opportunities for things to go right from here. And that may not necessarily mean a repeat of 2024 and 2023's 20+% returns in the S&P 500. However, what I think the opportunity to go right is that things that can broaden out a little bit. The market we're starting to get performance from areas that were not performing before. One of the chief complaints last year in particular was that the Mag 7, you know, the 7 high-flying tech stocks are holding up the market. It's the only reason that the S&P is doing well. And those stocks they're not falling apart, but they're not leading so far in 2025. The leaders this year are really the value names. We're seeing healthcare, energy, consumer staples. Those types of stocks are all doing really well. Bitcoin and digital assets related to Bitcoin, those things are not doing as well. International stocks, as we mentioned earlier, are doing better than domestic equities. So what we're seeing is that we're getting a broader base to this bull market. And I think that's a really good example of what could go right, which is the market's not falling apart. We are getting a change in leadership, which I think is super healthy. The economy is doing okay in spite of all these headlines that would have you believe that we're on the precipice of disaster. I think what could go right is that we have a super mediocre year in terms of stock market returns. Maybe it's high single digits, 10, 12% would be phenomenal. Of course, that's still above the historical average. But I think what's happened is people have gotten into this headspace of, you know, we've seen 20+% back-to-back years. We must be due for a crash. But looking back at the data, it's actually very rare to see a crash from all-time highs. That's not when markets crash. Markets crash typically when things are already tenuous. And things at this moment are not tenuous. The unemployment rate is still around 4%, which is terrific. We've got a healthy economy. Inflation, even though we seem to have stalled out in terms of going down from that high point in 2022, inflation is now within sight of the Fed's target. And really, in a lot of ways, we're sort of seeing Goldilocks. So I don't think we need to be complacent, but I also don't think investors should be preparing for the worst. You know, it's a great time to mentally prepare for maybe a little bit more turbulence than what we've seen the last 2 years, but you know, great opportunity to enjoy the fact that parts of your portfolio that you were really sort of hating in years past are starting to actually deliver some performance.